This fund averaged 28% a year for 10 years. Would you have invested in it? Think about it. 28% a year. So that, if we take our trusty calculator, divide by the rule of 72, take 72, divide by our rate of return, 28%, we'd have doubled our money every 2.5 years. So if you put $50,000 in this fund, it would be worth, well, 2.5 years. That's 4 times. You would have quadrupled your money. We go 50,000 to 100,000 to 200. You would have got $400,000 if you put your 50,000 bucks in. Within 10 years, you would have got $400,000. Isn't that crazy? Be honest though. You think you would invest in it? So check this out. This is part of my course. This is I'm doing some research for my course, Investment Basics for Regular People. Probably got to come up with a jazzier statement than that, but title. Does that sound good? Tell me what you think in the comments. Is Investing Basics for Regular People. Is that a good title? Or I was thinking, I will teach you how to invest, but I kind of don't like that one so much. It just sounds too salesy. I'm not pushing anything here. I will teach you how to invest. I don't want to say you should buy stocks first. I'm not doing that. We're going to talk about stocks and bonds, all that stuff. But I want to say you should. Investing Basics for Regular People. That's the best thing I can come up with. It's kind of boring though. I need something more bit jazzier, I think. But I can't. I don't want to be like over the top, like my report, my returns. I don't want to be like these sales guys. That's not what I'm trying to do. Because I want to show you basic investing for regular people. That's literally what I want to show you to do. Anyway, give me your thoughts on that. All right, so here, consider gold. This is from Morningstar in 2011, right there. Gold is grabbing investors' attention again. It hit a record high on Thursday when the Dow fell nearly 513 points. Gold closed at 1665. 1665 gold closed at. Some financial analysts say that investors afraid of risk should still take refuge in gold, although its price has shot up 73% in the last 2 years. There are better ways to invest in gold. No, there's not. If you're investing in gold, buy the freaking bullion. Mutual funds that invest in companies that mine for gold and other precious metals. And many of these funds pay a dividend, which will add to the investor's return. So here we got our 10-year USA precious metals, 28%, amigos. 28% a year over 10 years. That's freaking insane. I mean, literally, would you have bought that fund? So check this out. 1990 to 2000, this fund right here lost money. You put 10,000 bucks in 1989, December 31st, 1989. By the end of 2000, you're down to 5,400 bucks. All right, look at these. You lost 26%. You had a big year in 1993. You lost. You got crushed. You got crushed again. So would you literally think you would invest in this? Our standard deviation is 32%. Our compounded annual growth rate is -5. All right, so now let's say you started in 2000, just for simplicity. And we're going to go to the end of 2005. Let's see what it did those years. All right. So 2000, 2005, whoa, it went from 10,000 to 40,000. That's pretty good, especially when you compare it to, we'll just do VTSMX, Vanguard Total Stock Index. All right. So Vanguard Total Stock Index, it smoked it. Look at that. Total Stock Index is only up to, basically still underwater at this point because of 2000, 2001, and 2 debacle. But your gold and precious metals has averaged 25% a year. 25% a year. Where Total Stock Index is down 0.24. All right. So I think we can all admit no one's going to invest in the gold and precious metals fund right here. It averaged -5% a year the previous 10 years. Right. No one's going to invest in it. Now, so if you didn't invest in it now, when did you invest in it? You think you invested it right here? Think you invested it right there? You invested it right here. All right, if even that, I bet you probably did. You probably say, "Oh, that has a nice run." If I take some gains off the table, but I'm not putting my money in now. So that is such a nice run. All right, so now let's go to 2000 and 2010. And there's a moral to the story here, by the way. And if you keep wondering what I'm looking at, just see if my wife just texted me. She's not. So here, 25.78% compounded annual growth rate. $10,000 is now worth freaking $124,000. All right. Standard deviation 35. Best year is 71%. Actually, I didn't see what the standard deviation was before the whole. I'm curious what the standard deviation was from 1990 to 2000. Right there. So it's 35 then. Let's see what it is now. The bad years, I'm sure Sterling's going to be high. Yeah, 35. Didn't change much. Isn't that interesting? So from 2000 to 2010, you just destroyed the total stock index. Look at this. It's freaking sickening. $10,000 is worth 124. $10,000 in the total stock index is worth $11,000. Now, mind you, Obama is now knee deep in the president's office. Everyone and their mom was freaking out about the helicopter Bernanke. Everybody and their mom. I'm telling you. I had a client at USA. I inherited him. I think he was from South Carolina. I remember this guy like it was yesterday. And I hated inheriting clients. Basically, inheriting a client means he was working with some guy. The guy he was working with left or something like that, and I got to hold the wet bag. I think this guy invested like $700,000 in the gold and precious metals fund in like 2010 or something like that. I can't remember because he said the inflation's coming. Only reprieve is gold and precious metal. I mean, a significant amount of money. I inherited him, 2014, I think. So watch what happens here. So this guy put like $700,000 in gold and precious metals. We'll even say he did in 2010. We'll say in 2010. And I think I inherited him in 2014, I think, is when I took over. And again, we didn't. It was different at USA. We didn't necessarily tell people what to do. If they had a certain amount of money with us, $1 million, they were assigned a wealth manager, which is what he did have. But I think he had $700,000, some significant amount of money. That $700,000 then proceeded to go down to 310. Where the S&P for the total stock went from to 1 point, it doubled. So the total stock doubled where he was halved. Isn't that crazy? If I can go to right here, he lost 15% a year. And I can't remember if I talked to him. I think I did. I said, dude, just take your losses, man. And I don't know what happened to him. But if we check down here to 2023, watch what happens. He's 700,000 is worth 488 15 years later, with the total stock index is worth 3.2 million. Crazy. Now, if we go back in hindsight to the start of the century here, let's see what it looks like here. $700,000 if he would have put it in 2000, which no one did. He actually made more money than the S&P, the total stock index. Isn't that weird? But the issue, my friends, is no one knew to do that. You can't chase performance. You just can't. It's always going to fire back on you. Always. And in my course I'm doing, I talk about two other funds, the CGM Focus Fund and then the Legg Mason Value Trust. I do the same scenario where both were the funds of the decade. Everyone's, cats me out, and everyone just got trounced. Well, Josh, aren't you chasing performance in the total stock index? No, because here's the issue. Let's go back to 2010, the total stock index. All right, so the total stock index from 2010 to now has clocked 12% a year. And that's pretty good. Do I expect it to clock that? Well, those freaking emails or junk people call me all the time lately. Well, I must be on some list. How did I get on that list? All right, is that are you clocking that? Are you expect to clock that 12% a year? No, you're not. Why? Because the 12% a year, the reason you're clocking that is because the previous decade was so poor. We go here, again, we go to 2000. It's just making up for what happened the previous decade. So we're back to basically even Steven going forward now. All right, so we lost our money in the previous decade. We've got it back essentially. So we're averaging about 6.63% a year, which would tell you, I think that's about right. I think that's probably what you should expect, 6% or so forward looking. So we lost all the money in the first decade, and then we got it back in the second decade of the century. And going forward, that would be a good expectation right there, with a standard deviation about 16%, 100%. Anyway, the point being, another reason is the total stock index is literally the total stock index. It's going to have some gold, it's going to have some REITs, it's going to have some small caps, it's going to have some large caps, it's going to have dividend payers, it's going to have growth stocks, it's going to have everything. So you're not really betting on, what you're doing if you're investing in the total stock index is you're literally investing in the stock market as a whole, the capital markets. And that's okay. That you can't, I mean, I guess you could. You say, I'm chasing performance. You're not chasing performance by investing in the total stock index. You're not. You're saying, I believe the capital markets. I think they have more upside than downside. I think a good capital markets assumption with some bonds on top of that is a good portfolio, because what else are you going to do? I mean, you could buy real estate at Grandship, but we're not talking about that here. Anyway, that's a lesson to be learned. And all these guys, they hated the G fund. They loved, I'm telling you, you'll hear it all the time. They'll go with what's hot. And I think they're all that in a bag of chips. So like, like Tesla. Buy Tesla or Bitcoin. Buy. I don't care what it is. They'll go with what's hot, and they'll think they're that in a bag of chips. And they will die with what's hot. It's crazy, man. They'll sink it because they're convinced the story. Peter Lynch's book, One Up on Wall Street. I think I got him back here. Let's see. He talks about, it's upstairs. Yeah, it's upstairs. He talks about investing in a story. So the fundamentals, yes, but investing in a story. And I'm going to do, on my course, I'm going to do too. I'm going to show you the fundamentals of Peter Lynch. There's an article written by, I think it's Business Week or something like that. Forbes. They say these are the 10 stocks under Peter Lynch's methodology he would buy now. And they did that in 2010, I think. I looked up each and every stock from then till now. Got crushed by the total stock index. Investing in the total stock index is not chasing returns. It's just chasing the idea that the capital markets will still perform with dividends and hopefully growth. That's not chase returns. Chase returns is the hot thing. Don't do that, man. It's a kiss of death. That's just, I can't guarantee you that, but it's pretty doggone close to being guaranteed. All right. Don't forget to subscribe. Live stream tonight. We're got a guy I'm going to interview who does his old solar photovoltaic. And I'm going to be very interested with a battery bank too. It'll be very interesting to see him talk about that. So I'm very much looking for that live stream tonight at 8 p.m. Eastern time right here. And if you like what I do and you want to support the channel, buy me a cup of coffee. It's in the doobie-doo. Love to hear your thoughts. We'll see you.